The funding is out there. Access the cash you need to impact your business. Chapter 2, Cash Flow, Capital and Business Growth. According to studies conducted by the Small Business Administration, lack of capital is one of the most often cited reasons for business failure. Another way to view capital is as a source of cash and cash flow. Businesses need cash to run operations and, if growing, to fund expansion. If your business has insufficient cash flow, it can run out of cash, resulting in business failure. Practicing cash flow management can help you identify any underlying existing or potential operational and financial issues within your business that could cause cash flow problems. I have worked with companies that have serious, operationally driven cash management issues, which cause them to need financing. Strong cash management practices can help all companies generate more cash and help stable, profitable companies reduce their need for external financing. Profitable, stable companies whose ownership or management team manages their cash well generate sufficient capital or cash flow from business operations. Their cash flow statements show a positive operational cash flow. Unprofitable companies typically generate negative operational cash flow. However, fast-growing companies also often generate a negative operational cash flow due to adding personnel, increasing sales and marketing costs, and incurring other expansion costs. When companies have negative operational cash flow, they need to generate cash from other activities to fund operations and expansion activities. First and foremost, cash is king. If your business is unprofitable, it can limp along for years if it runs its operations in a way that generates cash flow. For example, if it has customers prepay or requires deposits. However, if its cash dries up, it has no money to pay its bills and its employees, taxes, and creditors, and will be forced to shut down soon after this occurs. Because of the value of cash and the need for companies of all sizes to truly understand the difference between cash, profit, and capital, I am including a hopefully illuminated discussion of the cash flow statement. Cash flow. Cash and cash equivalents, that is, checks, wire transfers, publicly traded securities, are what your company uses to pay its bills. Cash flow is the inflow or outflow of cash at your company. Cash flows fluctuate during an accounting period, generally a month, quarter, or year, and may be negative or positive at any given time. Your company's cash flow statement provides a historical record of the cash flows that occurred during the accounting period. Your company can also use a cash budget to project cash flows for future periods to identify potential shortages and plan accordingly. Financial statements paint a detailed picture of a company's financial health. Unfortunately, most owners pay attention to the net income statement and balance sheet and ignore the cash flow statement. This happens at companies of all sizes, not just small companies. Most company accountants focus on paying bills and issuing invoices, generating historical balance sheets and income statements, reducing tax liabilities, and keeping costs low. The treasury function oversees cash management, but most companies with less than 100 to 200 million in revenue do not employ a treasurer. I have friends and acquaintances in the turnaround consulting business who can point to numerous poor cash management practices at companies of this size, which led to the company's financial distress and near failure. I say all this not to scare you, but to impress upon you how very important it is to manage your company's cash and detect issues and problems before or soon after they arise. This practice will help ensure you take sufficient steps in advance to address and resolve any underlying issues and obtain capital in advance of a critical need for it. To clearly understand your company's ability to cover expenses and liabilities, As a business owner, you must regularly assess the cash flow statement. So what exactly is a cash flow statement? A cash flow statement records a company's cash inflows and outflows. Stated differently, this statement presents the amount of cash and cash equivalents entering and leaving your company during a specified time frame. The cash flow statement enables you as the owner, your managers, bankers, and suppliers to view your company's operations from a cash perspective. Thus, all better understand how smoothly or not the company runs its operations, where growth funding is or will come from, and how wisely your firm spends its money. The cash flow statement breaks down the cash inflows and outflows into three sources of cash: operations, financing, and investing. Operational or operating cash flow. Operational cash flow measures cash inflows and outflows from your company's core business activities. This section of the statement shows clearly whether your company's revenue structure can cover all of its day-to-day operational expenses. If the revenues cannot, the net operating cash flow appears as a negative. If your company has a problem collecting on its receivables or is amassing unsold inventory, that issue will appear here. Late or missing payments by customers greatly restrict incoming cash. If your company has seasonal trends, cash flow may also vary by the accounting period. Monitoring the cash and projecting out operating cash flow can help you identify potential shortfalls in advance. Investing cash flow. Investing cash flow measures cash generated from or used in investing activities. This includes purchases or sales of equipment, property, a subsidiary, or business unit. This section reflects changes in items in the asset section of the balance sheet. If your company is growing rapidly due to all the capital expenditures made, your firm will typically show a negative investment cash flow. Struggling asset-rich companies often show continual asset sales that offset negative or low operational cash flow. A perfect example was Kodak in 2010 through 2012 when it finally filed for bankruptcy. Kodak sold off many assets during this time period to generate enough cash to cover the huge negative cash flow its operations generated. Financing cash flow. When your company produces insufficient operating cash and/or experiences negative cash flow from investing, it must generate cash through financing activities. Financing cash flow measures cash generated by financing activities, including the acquisition of new debt, issuance of equity, repayment of principal, and issuance of dividends. This section reflects changes in the liabilities and shareholders' equity section of the balance sheet. For example, a tech company that received a venture capital investment infusion will show the proceeds here. Periodic review of the cash flow statement. In general, all other things being equal, the higher the operational cash flow, the stronger your company. By periodically reviewing the cash flow statement, rapidly growing companies can identify the need for cash in advance and utilize financing to cover the shortfalls or fund growth. A troubled company could head off financial distress by noticing negative operating cash, minimal investing cash, and significant financing cash flow. Seeing various negative cash flows on the cash flow statement could lead you to restructure operations and revamp the financing structure before it becomes too late to do so. An example, you examine the cash flow statement and it appears that the sole purpose of new financing your company entered into is to replace old financing. You need to dig deeper, as this could be a warning sign. Your company may have brought in equity investors to pay off debt in preparation for a massive expansion. Paying off debt would reduce or eliminate cash outflows for principal and interest payments. Or your company may now have a better credit rating and have taken on new lower cost debt to replace old debt. However, The new financing also could mean that your company is treading water and does not have the operational cash flow to pay down the debt. In this case, the new debt is simply delaying a business failure, meaning you will need to dig deep into your operational practices to determine the cause of the issues and avert business failure. Stability. In general, companies with high positive operational cash flow have high financial stability. Reviewing your company's cash flow statement on a quarterly basis can help you identify any operational cash shortages that you need to cover with financing or investing actions. Looking at all sections can tell you if your company carries too high a debt load, which could lead to financial distress, or is selling off too many assets, which could leave behind a shell. A stable growing company augments operations with cash from financing during expansion periods and takes money from operations or investing to repay financing during periods of modest or slower growth. In the chapters that follow, I focus almost exclusively on generating cash flow from financing activities. If you read the first portion of this book and determine that access to capital may be your short-term need, but operational issues or a high debt load are the primary reasons for your shortages, refer to the sections at the end of the book, including the section entitled Resource for Assistance. As companies grow, their needs change. Companies that may need one type of financing from one source at one stage of growth will benefit from another type from a different source of financing at a later growth stage. One company that fits a certain profile will be able to choose from a variety of financing sources, while another company with a different profile may only have 3 applicable choices. What you need and can get in the second year of your business with $200,000 in revenue and no assets will differ significantly from your business's 5th year with $2 million in revenue and $1 million in assets. Consequently, this book will be useful to you and your company for a long time. This book will help you chart the best options for your company given your revenue range, industry, and existing debt profile. It will do this for you in your business until you qualify as a bank corporate client, typically a company with 40 to 50 million in revenues and up. Some banks qualify corporate clients as those with 100 million in revenue or higher. Companies tend to ignore building relationships with financing entities before they need them. If and when companies get around to accessing angel, early stage financing, VC, or PE firms, they often utilize relationships with others, such as financial advisors and attorneys, for introductions. Consequently, building direct relationships in advance with such funding sources, while important, is less critical. However, lack of existing relationships presents a serious obstacle for bank financing, direct lending, and similar financing. When companies do actually build relationships with lenders, it is typically with a branch manager. What happens when a branch manager leaves? If the company was on the cusp in terms of ratios, credit score, and other criteria banks use to make lending decisions, the company will often lose its line of credit. The new branch manager will either recall or freeze the line of credit because without knowledge of the company's history, any special cases or circumstances, or the owner's character, the new manager cannot vouch for the company. Consequently, the new banker cannot support the predecessor's credit decision and must adhere most closely to the lending guidelines. If you are the owner of an existing business and seek to acquire another business as a means of growing your company, in other words, you have an acquisition growth strategy, this book will provide you with a wealth of information regarding the various sources of capital to finance the purchase of that business or the assets of that business. If you are trying to keep the amount of capital contribution you or your company must make to acquire the target company to an absolute minimum, I highly recommend How to Buy a Business with No Money Down by Arnold S. Goldstein. Goldstein's book has a wealth of information that will help you achieve your goal of minimum personal or business cash outlay.